Hey everyone, ready to learn how to maybe get an edge in the stock market?
Sounds good to me.
We're diving into a classic today, One Up on Wall Street by
Huh?
Peter Lynch.
Oh, yeah, Peter
Yeah,
Lynch.
the guy who ran the Fidelity Magellan Fund with, incredible success.
Yeah,
So this isn't about becoming Wall Street gurus overnight.
right.
It's about understanding Lynch's principles and how they can empower us, everyday people to find promising companies before everyone else does.
Exactly. And that's one of the things I love about Peter Lynch's philosophy is that he really emphasizes that the individual investor has a real advantage over the Wall Street pros.
This dumb money advantage thing
Yeah.
really caught my attention.
Yeah.
How can we, the average folks, how can we have an advantage over those giants with all their, resources and fancy algorithms?
Well, Wall Street is kind of like a big, massive ship. It's powerful, but it takes forever to change direction.
Mm.
They're often bogged down by bureaucracy and rules and this herd mentality where they all kind of follow each other.
So individual investors are more like speedboats.
Yeah.
Exactly.
I'd agree to.
Zip around and explore those hidden coves.
Exactly. You have the freedom to be more curious, more flexible, and more willing to kind of dive into unconventional ideas.
That's so interesting. And, it reminded me of that story Lynch tells about being at Pebble Beach, that famous golf course.
Oh, yeah.
And he was so focused on his game that he totally missed the opportunity to think about whether Pebble Beach was a publicly traded company.
Yeah, it just goes to show that we can be so caught up in our everyday lives that we miss, potential investment opportunities that are right in front of us.
Yeah, and I think a lot of people are hesitant to jump into the stock market.
Yeah.
Because they think stocks are just riskier than bonds.
Yeah, that's a common misconception. And
Yeah.
Lynch addresses that head on in his book.
Yeah.
He argues that even holding on to these blue chip stocks that are perceived as safe can be risky in the long term.
Yeah, and the example of RCA comes to mind.
This classic blue chip stock? When GE acquired RCA in 1986, the share price was basically the same as it was in 1967.
Wow.
Talk about a long-term hold with no gain.
It just goes to show that timing the market is really, really difficult. It highlights that even established companies can face unexpected challenges.
Absolutely. So instead of, trying to time the market, Lynch has focused on identifying those companies with solid growth potential,
Right.
regardless of, their sector current market perception.
Think like a business owner, not a stock picker.
I like that.
Yeah.
Okay, so speaking of growth potential, let's talk about 10-baggers.
Yeah.
These are stocks with the potential to increase in value tenfold or more.
That's the dream, right?
That's amazing.
Yeah.
I mean, who wouldn't want to turn $1,000 into $10,000?
Exactly. And Lynch offers some really interesting insights into how to identify these potential 10-baggers.
What should we be looking for?
Well, this might surprise you, but one of the things that Lynch points out is that companies with dull or even ridiculous-sounding names can actually be a good sign.
Really?
Yeah, think about a company like Crown, Cork, and Seal.
Yeah. Not very exciting.
Not exactly glamorous, right?
Right.
But these companies with less flashy names often attract less attention from Wall Street analysts,
Interesting.
which means they're less likely to be overvalued, and that creates an opportunity for individual investors like you to potentially find some hidden gems.
So it's not about chasing the hottest trends.
Right.
It's about finding those overlooked companies with solid potential.
Exactly.
I like that. Okay, so what else should we look for?
Another characteristic that Lynch highlights is companies that operate in industries considered no growth.
New growth.
I know it sounds kind of counterintuitive,
Yeah.
but hear me out. When there's less hype around a particular sector, there's often less competition.
Okay. Yeah.
And that can translate into a more stable environment for companies to kind of grow steadily over the long term.
So it's like finding that quiet corner of the market where you can kind of, just watch things grow.
Exactly. Now, this doesn't mean you should just invest in any company in a no-growth industry.
Right.
You still need to do your research, look at their financials, and understand their competitive advantages within that sector.
So it's about finding those standout companies, right?
Exactly. The ones that might be overlooked because they're not in the spotlight, but they have the potential to be steady performers over time.
I like that. And, all this ties back to Lynch's idea that valuable investment ideas are often hidden in plain sight.
Mm-hmm.
Like that story about La Quinta Motels.
Oh, yeah.
Lynch was so intrigued by their simple concept. offer Holiday Inn quality at lower prices by cutting out amenities like, fancy lobbies and restaurants.
He didn't just read about it either. He
Right.
stayed at 3 different La Quintas
Wow.
to see for himself.
That's dedication.
Yeah.
Like you're saying, look, take the time to experience a company's products or services.
Exactly.
You'll get valuable insights.
You're not just looking at numbers on a spreadsheet. You're getting a feel for the company's culture and their customer service and their overall approach to business.
Yeah, it's like being a detective.
Yeah.
Gathering clues.
Exactly.
To understand the company's story beyond just the numbers.
Beyond the financials.
And speaking of stories, Lynch really emphasizes the importance of identifying a compelling company story before investing.
Yes.
But I'm guessing he's not talking about, rumors or gossip.
No, definitely not.
Okay.
It's about understanding the company's business model, their competitive advantages, and their potential for growth. What problem does this company solve? How do they make money? What sets them apart from the competition?
It's like, getting the big picture.
Yeah.
The forces that are driving the company forward.
Exactly. And it's not just a one-time evaluation either.
Oh,
You need to revisit the story as it evolves.
It's like check in with an old friend.
Yeah,
See
exactly.
how they're doing.
Make sure they're still on the right track.
Right.
And, see if anything has changed.
So you're saying, stay informed about the company's performance.
Yes. Track their earnings.
Yeah.
Pay attention to any announcements or changes in leadership.
Okay.
Ask yourself, is the company still executing on their plan?
Right.
Are their competitive advantages holding up?
Interesting.
Are there any new threats?
So, this really reinforces the idea that investing is an active process.
Absolutely.
It's not passive.
Yeah.
You have to stay engaged.
Yes. You're not just along for the ride.
Right.
You're in the driver's seat making informed decisions based on your ongoing research and understanding of the companies that you're investing in.
Now, let's talk about one of the biggest challenges, I think, for any investor.
Okay.
And that is knowing when to sell,
Oh, yeah.
especially when you found a winner.
Yep.
It can be tempting to hold on to it forever,
It really can.
hoping it'll just keep going up.
Right.
But we've seen with RCA, even those blue chips can stall out.
Yeah, you're right. Knowing when to sell is as important as knowing when to buy. And Lynch provides some interesting insights into this as well.
Okay.
He suggests that sometimes the best time to sell a stock is when everyone else is buying.
Wait, really?
Yeah.
When the hype is at its peak.
Yeah, it might seem counterintuitive,
Yeah.
but think about it. When a stock price shoots up dramatically, it might be getting ahead of its actual earnings and growth potential.
So it's like a party that's getting a little out of control.
Exactly.
And time to go home.
Yeah, you want to slip out before things get too crazy.
Right.
So if you've done your research and you believe a stock's price is outpacing its realistic potential, then it might be time to take some profits off the table.
Okay.
That doesn't mean you have to sell your entire position.
Oh,
You could trim your holdings,
right.
lock in some gains while still maintaining exposure to the company's future growth.
I see. So, it's all about finding that balance between riding the wave of enthusiasm, but not getting swept away by it.
Exactly. And it goes back to focusing on those long-term fundamentals.
Yeah.
Don't get caught up in the short-term noise of the market. Right. If you've invested in a solid company with a compelling story, you can afford to be patient and let that story play out.
It's like being a good gardener.
Mm-hmm.
You plant the seeds.
Yep.
You nurture them. You give them time to grow.
Exactly.
And you don't panic when the wind blows or there's a little rain.
Absolutely.
Mhm.
Investing, like gardening, requires patience and attention and a belief in the natural process of growth.
That's a great point to end on for this part of our deep dive.
Yeah.
We've covered a lot of ground, from the dumb money advantage to those 10-baggers.
Uh-huh.
We've even talked about the challenges of, when to sell.
Absolutely.
But the adventure isn't over yet. In part 2, we'll delve even deeper into Lynch's insights,
I can't wait.
exploring how to analyze those company stories, evaluate their competitive advantages, and make informed decisions about, when to buy and when to sell.
So stay tuned.
Stay tuned, because the deep dive continues.
It does.
Welcome back. Ready for more on One Up on Wall Street? Let's go a little deeper into those company stories that Lynch talks about.
All right.
It's one thing to identify a company that looks promising,
Right.
but how do we really understand its narrative? Like, is this a good investment?
Yeah. You really have to get to the heart of the business.
Yeah.
It's about understanding its core operations, its competitive advantages, and its potential for sustainable growth.
Okay, so we're not talking about like a marketing campaign or a slogan here.
Right. Definitely not. It's much deeper than that.
Okay.
What problem does this company solve? How do they make money? What sets them apart from the competition? These are the questions we need to be asking.
So it's like building a case file
Exactly.
on the company.
Yeah.
Right. And we're gathering evidence to see if it's worth our investment.
Right.
So what kind of evidence should we be looking for?
Well, one of the first things you want to look at is the company's business model.
Yeah.
How does it actually generate revenue and profits?
Mm-hmm.
Is it a straightforward model? Something easy to understand, or is it complex and convoluted? Lynch prefers companies with simple, transparent models.
Oh, that makes sense.
Yeah.
Yeah, if you can't explain how a company makes money, that might be a red flag.
Exactly. It could be a sign that even the company itself doesn't have a clear understanding of, what they're doing or how they're making money.
Right. So once we kind of understand the business model, then we need to look at competitive advantages.
Absolutely.
Mm.
What does this company do better than its rivals?
Mm.
Do they have a unique product or service? Do they have a strong brand reputation?
Yeah.
Are there high barriers to entry in their market?
So these advantages are like, they're secret weapons,
Yes.
giving them an edge in the marketplace.
Right.
But aren't some advantages, more durable than others?
Absolutely. Some advantages like patents or exclusive access to resources
Yeah.
can give a company a long-lasting edge. Others, like a trendy product or a charismatic CEO, might be more fleeting.
Okay. So it's important to assess the sustainability of those advantages.
Yes. Are they likely to persist over the long term, or are they vulnerable to disruption? That's what you need to figure out.
I remember Lynch talking about companies that buy back their own shares.
Uh-huh.
He seemed to view that as a good sign.
He does, and for good reason.
Okay.
Share buybacks signal that a company believes that its stock is undervalued.
Oh, interesting.
They're essentially putting their money where their mouth is and investing in themselves. Plus, buybacks reduce the number of outstanding shares, which can increase earnings per share,
Okay.
and that can boost the stock price.
It's like they're saying, we believe in our future.
Exactly.
But even if a company, checks all the boxes in terms of its story, it's not set it and forget it, right?
No, you're absolutely right. A company's story is constantly evolving.
Okay.
So it's crucial to continually revisit the narrative and make sure that your original investment thesis still holds true.
So like checking in on an old friend,
Exactly.
see how they're doing.
Yeah, you want to see how they're doing, make sure they're still on the right track, and see if anything has changed.
Okay, so stay informed,
Yes.
track their earnings.
Read industry news.
Okay.
Pay attention to any major announcements or changes in leadership. Ask yourself, is the company still executing on its plan? Are its competitive advantages holding up? Are there any new threats on the horizon?
So much to think about.
It is, but it's all part of being an engaged investor.
So how often should we be, checking in on our companies? Is there a rule of thumb?
There's no hard and fast rule.
Okay.
It really depends on the company and the industry.
Right.
Some companies might warrant more frequent check-ins, especially those in, fast-moving sectors.
Okay.
Others that are in more stable industries might not need as much attention.
So it's about finding that right balance between
Exactly.
staying informed
Yes.
but not getting overwhelmed.
You don't want to be constantly second-guessing your decisions or making impulsive moves based on, short-term fluctuations.
Yeah.
Remember, Lynch advocates for a long-term perspective,
Okay.
but that doesn't mean you should completely tune out.
Right.
Stay engaged enough to make sure your investment thesis is still intact.
Wow. It's amazing how much goes into, evaluating a company.
Yeah.
It's like peeling back the layers of an onion.
It is. It's not a surface-level exercise.
Right.
But that's what makes it so rewarding. When you
Yeah.
really understand a company,
Yeah.
its strengths and weaknesses, its potential,
Yeah.
you can make, more informed decisions.
Speaking of decisions,
Okay.
let's talk about one of the toughest calls for any investor,
Right.
when to sell.
Oh, yeah, that's a tough one.
It's so tempting to hold on to a winner, right?
It is.
Hoping it just keeps going up.
Right.
But as we saw with that RCA example,
Yeah.
even blue chips can stall or decline.
You're right. Knowing when to sell is just as important as knowing when to buy.
Yeah.
And Lynch offers some good advice on this, too.
Okay.
He suggests that sometimes the best time to sell a stock is when everyone else is buying.
Really. When the hype is at its peak.
Yeah. I know it seems counterintuitive,
Yeah.
but a stock's price doesn't always reflect its true value.
Right.
Sometimes emotions and speculation can drive the price up way beyond, what the company's earnings and growth potential actually justify.
So it's kind of like a party that's getting a little out of control.
Exactly.
You want to leave before
Yeah, you want to slip out.
things get too crazy.
Before things get too crazy.
Right.
So if you believe that a stock's price is getting ahead of itself,
Yeah.
it might be wise to take some profits off the table.
So you're saying you don't necessarily have to sell your whole position.
Right. You could just trim your holdings,
Okay.
lock in some gains, but still keep some skin in the game.
I see. It's about finding that balance,
Yeah.
between riding the wave
Yeah.
and not getting, wiped out.
Exactly.
And it all comes back to focusing on the fundamentals.
It
Yes.
does. Don't get distracted by the short-term ups and downs.
The noise.
The noise. Yeah. If you've invested in a good company,
Yeah.
you can afford to be patient.
It's like being a gardener.
Uh-huh.
You plant the seeds.
Yeah.
You give them time.
You nurture them.
You don't freak out when it rains.
Exactly. Investing is like gardening.
Yeah.
It requires patience, attention, and a belief in that natural process of growth.
Well said. So as we wrap up this deep dive into One Up on Wall Street,
Okay.
what's the biggest takeaway you hope our listeners, walk away with?
The individual investor has a real advantage.
Yeah.
You have the freedom to be curious, to think independently.
Could be a speedboat.
Yes, exactly. To explore those unconventional ideas.
Yeah.
You're not bound by the same rules and constraints as those big institutions.
Right.
You can be nimble, you can be selective.
And we can use our everyday experiences
Exactly.
to, uncover those hidden gems.
So the next time you're at the mall,
Yeah.
or trying a new restaurant,
Okay.
keep those investor ears perked up.
I like that.
Mhm.
You never know where you might find inspiration for your next great investment.
It's all about connecting the dots between your daily life and the world of investing.
That's a great point. And, investing isn't just about making money.
No, it's not.
Right. It's about being part of something bigger.
It is. It's about participating in the growth and innovation of these companies that
Yeah.
are shaping the future.
And on that note, we'll leave you with this final thought.
Okay.
Keep exploring,
Yes.
keep learning,
Keep learning.
and keep believing in your ability to succeed
I love it.
as an investor. Until next time, happy investing, everyone.